Hi everyone. Now let's continue the session of Asian economic crisis. So the vicious cycle that turned a currency crisis into a full-scale financial and economic crisis. Many Asian companies had borrowed heavily in US dollars because interest rates were lower than domestic loans. However, when local currencies began to lose value, the cost of repaying those foreign loans increased dramatically. This created a chain reaction. Rising debt led to bankruptcies. Bankruptcies caused investor panic. Panic triggered capital flight, and the resulting currency depreciation made the debt even more expensive. This self-reinforcing cycle tapped many economies and deepened the Asian financial crisis. Now let's see about this cycle. Currency drop. The cycle begins when the domestic currency loses value against the US dollar. For example, if the exchange rate doubles, borrowers need twice as much local currency to repay the same dollar denominated debt. Then the debt explosion, because loans are denominated in US dollars, the depreciation of the local currency dramatically increases the debt burden. Even financially healthy companies suddenly struggle to meet their repayment obligations. Then insolvency, as debt incomes becomes unmanageable, businesses and financial institutions began to default on their loans. Bankruptcies increase, bank experience rise in non-performing loans, and the overall financial system weakens. Then finally, the panic. Seeing these problems, investors lost confidence and withdraw their investments. This capital flight places even greater pressure on the country's currency, causing it to depreciate further. The cycle then repeats itself, making the crisis progressively worse. The most important lesson from this is that foreign currency borrowing without proper risk management can create a dangerous feedback loop. Once exchange rates begin to fall, debt grows rapidly, confidence collapses, and the financial crisis feeds on itself until decisive policy action breaks the cycle. And here you see, uh, it demonstrates the concept of financial contagions, the rapid spread of an economic crisis from one country to others. Although the Asian financial crisis began in Thailand, it quickly affected neighboring economies because of their interconnected financial markets, similar economic structures, and reliance on foreign investment. As investor confidence declined, capital flowed out of multiple countries, currencies weakened, and stock markets fell. The map illustrates that while some countries were severely impacted, others experienced indirect effects through reduced trade, investment, and economic confidence. Let's see the map more. Uh, epicenter, most severely affected countries you can see here: Indonesia, South Korea, and Thailand. These countries formed the epicenter of the crisis. Thailand triggered the crisis with the collapse of the baht. Indonesia experienced a dramatic depreciation of its currency, widespread corporate bankruptcies, and severe political instability. South Korea faced a liquidity crisis, forcing major corporations to restructure and seek international financial assistance. Then let's see collateral damage countries, which is having significant spillover effects: Hong Kong, Laos, Malaysia, and Philippines. Although these countries did not initiate the crisis, they were significantly affected. Investors feared that similar weakness existed in their economies, leading to capital outflows, falling stock markets, and currency depreciation. Governments had to implement emergency measures to stabilize their financial systems. Then the peripheral impact, indirect economic impact, it's meant Brunei, China, Singapore, Taiwan, and Vietnam. These economies were less affected directly because of stronger economic fundamentals or different financial structures. However, they still suffered from reduced exports, declining foreign investments, slow economic growth, and weakened regional business confidence. So why did the crisis spread so quickly? There were several reasons why the crisis spread across Asia. First is interconnected financial markets, which means that investors treated many Asian economies as a single investment region. Second, heavily reliance on short-term foreign capital that made countries vulnerable when investors withdraw funds. Third, similar economic structures, including fixed exchange rate systems and high foreign currency borrowing, increased the risk across multiple countries. Fourth, investor panic caused a domino effects where fear spread faster than the underlying economic problems. So the key lesson from this is that an interconnected global economy, financial crisis rarely remain confined to one country. A loss of confidence in one market can rapidly spread across borders, affecting countries with strong and weak economies alike. This is why regional cooperation, sound financial regulation, and effective crisis management are essential to maintaining the financial stability. Thank you very much, and we'll meet again for the next session with continuation.